Hey, good morning. This is Mayor Walensky with Driving Markets. Hope you're well. Okay, so what happened on Friday, a big warning, sorry, anything said in this piece is media only. It's for publication and opinion. It's not advice, not financial advice, not investment advice, not a financial advisor. Let's move on. So what happened on Friday is that the markets were absolutely tanked. Now they tanked because, again, of the lack of surety, the lack of the nervousness regarding interest rates. Now, what's happened is very simple, is that Jerome Powell and the Fed have indicated, as well as other central banks, that they're going to aggressively attack interest rates. However, they put no timetable on there, and this lack of timetable is making the markets nervous. They're having to guess when is the end of the cycle of the interest rates. I'm going to tell you now, the end of the cycle of the interest rates is not going to be for at least 12 months, maybe 18 months. What's going to happen is that rates are going to rise all the way through 2022 and obviously 2023. Now, when they rise through 2022 and 2023, just get myself sorted out here, sorry for the camera, excuse me. They're going to rise to around about 6.5% to 7% in the US. In the UK, I would suggest probably around about the 6% level in the UK by 2023. Now, all of this has sent nervousness into the financial markets. And as a result of that, they're worried about recession, because higher interest rates pulls money out of the economy. What you've got at the moment is full employment. Now, you've got full employment for several reasons. The main one being the pandemic. The pandemic pulled out huge amounts of the workforce. Some of them died, some of them have got long-term illness, and furthermore, some have just decided not to go back to their original job. So there is a shortage of manpower in every industry. That is keeping effectively the economy going through the purchasing power and the retail sales and the consumer power of the individual that's employed. However, as companies contract, you're going to end up with a higher level of unemployment, and you're going to start seeing that around about the January time as unemployment rises. As unemployment rises, that's going to affect obviously sales, retail sales, consumer spending, and that's going to have an effect on the profitability of all of the major companies that we deal with, whether they're Apples or the Facebooks or the Netflix or the Barclays or the Boots or whichever international shares or local shares that are publicly listed. Their profits are going to be impacted as a result of rising unemployment. So let's just have a quick recap of where we're at. We're at high inflation or rising inflation. Now, what's interesting on inflation, oil has come down on Friday due to fears of recessions. Now, it's now running at $78 a barrel and could go all the way down to 70 or even 65. And that'll push inflation down. However, all the other inflationary factors of the supply line are still there. And I'm not sure oil will be sufficient to reduce inflation to the level where central banks will stop raising interest rates. So you've got high inflation, you've got lockdowns in China, you're going to have some tension between China and Taiwan. You've got the war with Russia and Ukraine, whereby Russia has now drafted, I don't know, 300,000 or million soldiers, I'm not sure what's going on, with the underlying threat that Putin says this could end up being a nuclear confrontation. If it's a nuclear confrontation, kiss goodbye to everything. However, let's say there's not going to be a nuclear confrontation and the war's going to continue in Russia and Ukraine. What you're going to have is you're going to have continuous nervousness, and the markets are going to go down. You're going to see at least next year a 25 to 30% drop in equity markets. On Friday, the pound dropped 400 points against the dollar. It's been absolutely trashed and hammered because there is serious concern that England, the UK, is now in a recession or going into a deep recession, and therefore the pound was sold off. It's the lowest it's been in more than 37 years. It's never been this low, and it could actually reach parity with the dollar. However, at some stage, all the bad news will be in that particular pound dollar or within the pound. Any good news will push the pound up. So I think medium term to long term, the pound is a buy, but short term, the trend is definitely down. You could see the pound go all the way down to 105 to the dollar or 104 to the dollar. Hopefully it's not going to end up like the euro, which is running at 97 to the dollar which is on the way also to being trashed because Europe is going into recession. As regards Bitcoin and cryptos, Bitcoin, there's some weird views out there that Bitcoin by October is going to be $100,000. I don't know where these views are coming from. Bitcoin is going to go down to $10,000 or lower. Mark my words, by the end of October, you'll see Bitcoin at around about the $10,000 mark. And as I said earlier on in previous publications, the Nasdaq also is going to go below 10,000. It's already practically there. It's only a few hundred points away from being below 10,000, because anything in the high-tech sector is high risk, and most of the high-tech sector, I'd say around about at least 50%, maybe 70% don't make profits, and therefore investors and traders are dumping high-tech stocks and moving out. Going on to Facebook, I'm a big seller of Facebook. Facebook's going to go well below $100. Apple's going to go below $100. Amazon's going to lose at least 25-30% over the next 6 months. You've got Netflix going to be out there. Google's also going to go down there. Besides all the semiconductors, Nvidia is also a big sell. Okay, this is Mayor Valensky with Driving Markets, wishing all our Jewish viewers a happy New Year, happy Rosh Hashanah. Speak to you in a couple of days. There'll be no broadcast tomorrow or Tuesday. All the best.